A little bit about LTCCC. For those of you who are not familiar, we are a nonprofit, nonpartisan organization entirely dedicated to improving care and quality of life for people in nursing homes and assisted living. We focus on policy research and analysis. We do a lot of data work in that regard. We publish data, especially on nursing homes for the public, and we use those data in our own analyses of quality and other issues related to nursing home care. And we use that all as a basis for systemic advocacy and public education. And lastly, we're the proud home of two local long-term care ombudsman programs here in our home state of New York. Our website is nursinghome411.org. And without too much further ado, I'm going to introduce our speaker today, Ed Dudensing. He will be talking about the expanding role of big finance in long-term care, what it says about profitability and resident well-being. And Ed is an elder abuse litigation attorney. He has been involved in a lot of really groundbreaking work, one of which I'll just quickly mention is that he did some really, in my view, remarkable work holding a chain that happens to be in California accountable for misusing money and frankly leaving their residents with serious neglect and abuse issues. It was the subject of an article, and the article's title is called Wealth Extraction from a Nursing Home Chain with Individual Private Equity and Real Estate Owners. I'll repeat that for those of you who are interested. Wealth Extraction from a Nursing Home Chain with Individual Private Equity and Real Estate Owners. And that really talks about, and it's actually, of course, made possible by the work that he did, but also the data and information that came forth from his case there made possible the exposure that this article provided. So we appreciate Ed very much for, of course, his work to hold nursing homes accountable when residents are abused and neglected, and also for bringing to light so much of what is going on in nursing homes and in the industry. And with that, I'm going to hand it over to him. Thank you so much, Ed, for joining us today.
Thank you very much, and I will share my screen here so that we can get started. Let's see if this works. Is that working?
Yes, yeah, there you go.
Okay, great. Give me a moment here. All right. Thank you very much, Richard, and thank you for all the work that your organization does. I think you are so focused on the issue of transparency, and for good reason. It plays such a huge role in addressing what the root causes are of some of the problems that we have in long-term care. And one of the things that we have tried to do in our work, advocacy work, in terms of litigation of these cases, is to try to get at root causes, to tell the jury that we're aiming at root causes. And so this is a discussion today about the role of big finance in long-term care. And what I'm going to do today is talk about two big finance vehicles, one of which is private equity, and another is real estate investment trust, better known in the public domain as REITs. And I'm going to start by giving kind of a little bit of an overview of what these types of financing vehicles are, and why we should care about them in terms of being advocates for good nursing home and assisted living facility care. And then I'm going to give a few essentially case studies talking about some of the actual particulars of how it plays out that when these individuals have control or ownership of long-term care facilities. So I'll begin with private equity. What is private equity? This is my fancy Google definition of private equity. Private equity is a type of investment where firms pool capital to invest in companies that are not publicly traded on a stock exchange. So the firms actively manage the companies. We're going to get into that through strategies like leverage buyouts or growth equity investments with the goal of improving the company's performance and selling it for a profit. And who invests in private equity? Typically, those are large institutional investments. That can be, for example, in the state of California, the retirement pension, CalPERS, CalSTRS. You have large individual net worth individuals, and they invest basically into a private equity fund, sort of a blind fund, at which point the private equity operator then goes out and makes investments in companies. And we've seen the portfolios of these private equity companies invest in all kinds of things, such as software and wine and things like that. When they start investing in long-term care, however, we believe there is a fundamental misalignment, and I'm going to talk a lot more about that in a second. But first, let's talk about ownership trends in terms of private equity and long-term care facilities. The data are not great in this area because of what Richard alluded to. There is a lack of transparency regarding ownership. But in general terms, broad strokes, it is generally believed that about 13% of facilities are owned by private equity. And that's starting from a base of about zero in 2000. That's when private equity started to get involved. And this growth has been significant and continuing up to the present time. So private equity is something that we are definitely contending with. And it's so critical to know who owns these facilities when you're talking about how do we make care better? What are their motivations? What are they doing? What are their actions? How can we regulate them? It all starts with knowledge. Knowledge is power. Additional data points would be, this is just in the public domain. Private equity invested $200 billion on healthcare acquisitions in 2021 alone and has invested $1 trillion in the past decade. This is all healthcare, not just long-term care, but it does give you a general sense of the level of involvement of private equity in healthcare and also, as described in the last slide, in long-term care in particular. Richard referred to this, but efforts have been made, of course, to bring greater transparency to private equity ownership so that, first of all, consumers can understand who the owners are of the facility to make their own informed decisions, but also so that there can be regulation of these entities. We first have to know who they are. As discussed, there's been rollbacks of efforts to increase that transparency, which make it difficult to know the true extent to which private equity is investing in long-term care. Impact on quality of care. The research in this area is still somewhat nascent, but there are plenty of studies that have shown significant negative impacts of private equity investment in long-term care in terms of mortality rates, hospitalizations, other quality metrics, and meanwhile, an increase in government spending. And the reason there's an increase in government spending is because there's an increased focus in maximizing recovery through the Medicare system, through the PDPM, and the prospective payment system before that, the PPS. And there are ways to maximize that recovery. And of course, with private equity involved, there is a big focus on increasing, revenues, which also increases the expense, but the care is not there. And there's another data point here, which is you see declines in registered nursing hours, registered nurses being supplanted by licensed vocational or licensed practical nurses, depending on what jurisdiction you're in, which has a correspondent effect on the quality of care. There's lots of literature out there about the importance of registered nurses in terms of supervision and general oversight in long-term care, and then increases in deficiency scores after acquisition by private equity. So a quick little overview about REITs now. What is a REIT? A REIT is a real estate investment trust. It's a company that owns, operates, or finances income-producing real estate. REITs also allow individuals to invest in a portfolio of properties like apartments, shopping malls, or office buildings without the hassle of directly owning and managing them, and they can be bought and sold on major stock exchanges like stocks. So the structure makes real estate investment more accessible and liquid for individual investors. Again, in terms of who invests in REITs, it is largely large net worth individuals as well as institutional investors. What's happening with REITs? This is from an article referring to the gray wave and opportunities in U.S. senior housing, and it talks about how the 25 largest institutional portfolios own about 445,000 units, or 39% of the total. This is talking about long-term care in the assisted living space. And REITs comprise the largest ownership segment with nearly 230 units, or 20% of the total private pay senior housing market. Welltower being the largest and Ventas being the second largest. So according to the literature, REITs own about 12% of all skilled nursing assets as of 2021, equating to about 1,870 facilities. And REITs typically are known to own about 20% of the total private pay seniors housing market, which is the assisted living facilities and memory care units. And those numbers are only increasing, both as it relates to REITs and private equity. It needs to be our business to understand what these entities are, how they operate, and how we as advocates for elders living in these long-term care facilities can approach modifying the current state of the law so that we can get the best care. REITs have the same sort of data, again, very early on in the research phase in terms of the impact, but the data so far is pretty clear that REIT ownership is certainly something that has been equated with lower quality of care, increase in deficiency scores, material declines in RN hours to cut costs. And so REITs, just like private equity, have been associated with worsening quality of care. So this is definitely not a good trend. So one of the questions that always comes up is, and we're in an existential fight with the industry regarding whether long-term care ownership and operation is profitable. And what I always say as my first line of discussion before you get to data points, and of course, those data points are often manipulated by related party transactions and things like that to make profits look less. All you have to do is ask the experts. When you look at the individuals who are involved in private equity and real estate investment trusts, they are enormously sophisticated. And the fact that they are continuing to increase their share of ownership in long-term care tells you all you need to know about whether operation and ownership of long-term care is a profitable play. They would not be investing and increasing their investment year over year, year after year, if it weren't for the fact that this is a good financial play. There is plenty of profit to be garnered, and you don't even have to look at dollars and cents in terms of what shows up in cost reports and things like that. When you just understand that the people who are underwriting investment here are very sophisticated, and they are choosing long-term care more and more as a place to park their money. So going now into just a little bit of a deeper dive by using case examples. Richard referred to the sort of landmark case we had a couple of years ago that involved a private equity company where we put private equity on trial. And so I want to talk a little bit about that. I think it's always interesting when you're trying to think about how does private equity exert its control? You can hear general statements, but when you start to see some of the details of that, it can be pretty astounding in terms of awakening us to what actually is going on when private equity gets involved in ownership. So you're going to see a bunch of slides now that are actually part of slides that I presented in my openings and closings, opening statements, closing arguments in this case that I'm referring to, which was captioned Rios v. Plum, and had an eventual outcome of a $30 million verdict against Plum, which was at that point majority owned, or the largest owner was private equity. So the three things that you need to understand about private equity, just look at the basics, is that, a lot of times before big finance got involved, ownership of nursing homes and long-term care facilities in general would come from, individuals who perhaps they were prior administrators, perhaps they had some sort of healthcare connection where, part of the reason they went into owning nursing homes and long-term care facilities was to provide good care and provide a home for our elders. That completely disappears when you have private equity. Private equity has a fundamental misalignment here because their main goal is to maximize profits. And when I say their main goal is to maximize profits, let me just explain that in a way that we can understand. The first thing is that, when we're all judged by, certain markers in the work that we do. For private equity, the way they sell and the way they attract investment for future funds is by their return on investment in their existing funds. So what they are trying to do at all turns is to maximize profits for their investors so they can raise money for their next fund and so on and so forth. So the first thing is that these individuals who invest they're blind investors. They're not investing in any particular cause. And so private equity is treating all of its investments in the same way, which is as vehicles for maximizing profits so that they can show the biggest returns. But that's just the beginning of why private equity is misaligned. Many of you have probably heard of the phrase carried interest, because there has been discussion over time as to whether the degree to which carried interest should be taxed. And what carried interest refers to is the fact that in the private equity world, you have a private equity fund, which consists of a team, for example, that has the fund maybe, 4 or 5 people that are working on a case. Well, when they get an investment, and if that investment, let's just say that private equity invests in, as it was the case in Plum, they invested the first time, they invested $150 million on year one, and they got a $300 million return in year 5. So that they doubled the money over a 5-year period. That was $150 million worth of profit. And the way carried interest works is that 20% of that profit goes just to that small group of private equity workers who are working for a private equity company. So that doesn't even go to the investors. So that 20%, you can imagine, that's $30 million in the hands of, or in the pockets of these relatively small group of private equity individuals who are running the private equity company. And on top of that, they get management fees of typically 2% of the amount invested on a yearly basis. And so they have enormous personal financial motivation to maximize profits on top of the fact that they are being judged in the marketplace by the maximization of profits. The second thing is that they are actively involved in the operation. They are not passive. So in other words, when it comes to private equity, they get seats on the board. Literally, they are going to board meetings and they are actively involved. They can send emails, and we're going to see some examples of that. But this is not a situation where they are just passive investors and they let the nursing home operators do whatever they want. They are sitting on the board, they are sending emails, they are asking and requiring reports in terms of, obviously they control the budgets, and then they want to see variance reports which show variations from the budget. So these are very actively involved individuals, even though they don't have expertise in healthcare. That's a pretty toxic mix. And the third thing is that they are short-term investors, 5 to 7 year hold period. That's what they promise when they're raising their funds. So they don't have flexibility in that. Now, one of the things that we always talk about and always recognize is that you do not want to have short-term thinking in the operation of long-term care. Those things are very opposed to each other in terms of trying to get quality outcomes. And so the fact that we have a type of investor that must sell after a very brief period is inimical to what we're trying to accomplish in terms of having long, steady leadership rather than looking for short-term returns. So this is an actual slide. As I mentioned, these are slides that actually come from the closing argument that I made in the Rios case. And all of these different topics here talk about different things that we saw through the emails and through other documents in terms of private equity exerting its control over the operations of a long-term facility enterprise. Plum was the largest operator of skilled nursing facilities in the state of California at the time of these events. So first thing I have identified here is concrete plan to liquidate. I already talked about that a little bit, but this is very interesting. The purchase of Plum, 80% of Plum by private equity in 2007 occurred in the year 2017. Actually, this is when they came back in the second time where they got 40% and they were they had the largest ownership stake. But when they purchased in 2017, within months of purchasing, they started looking at the scenarios of how they were going to sell 5 years down the road. In other words, the beauty pageant had already begun immediately upon the purchase. They're thinking about their exit strategy. We talk about short-term, the short-term ownership and why that's a bad thing. But it's not only that okay, they're going to only hold for 5 or 7 years. It's the fact that they start planning from day one. So what makes an investment attractive when you think about things from a short-term perspective? You need returns not just in years 4 and 5 or 5 and 6, but also in years 1, 2, and 3, so you can show a profitable picture the entire time. And what that means is that this profit-seeking maximization of profits begins from the get-go. Also, what we saw in the Rios v. Plum case was corporate micromanaging of skilled nursing facilities. And I'm going to give you an example here. This is something from, you can see here from a gentleman by the name of Naveed Hakim, who was the CFO of Plum, and he's writing to Howard Park, Alex Fraser, Dave Crater, Keith Collins. This group here is the GI Partners Private Equity Group. And basically what you can see is he is reporting, this is a weekly census update. So for those of you who are thinking, oh, well, they're not going to get involved in the details of the operations, and they're not going to be putting pressure on, the operations for, on any kind of real-time basis. Weekly census update. Overall census up 5 due to ongoing Medicare and managed care stabilization. Census, skilled census flat, up 6. And so you can see that the CFO is having to report on a weekly basis the literal granular census that's going on within the Plum enterprise. So you could only imagine what this means in terms of the pressure that's being put on operations to increase census and also correspondingly to keep costs down. Project Olive Tree. One of the things that we would see here, and it's an interesting thing that is discussed as well in the next slides, which is that Plum, the reason they created their name, or that they came up with Plum, was because it was, they described it as being organic, and this is what they wanted to tell their the consumers who were interested. They named all their facilities. They all have some sort of plant or organic life. Well, private equity comes in and they create this, olive tree initiative, so it has this beautiful sound to it. It's like part of the organic Plum, but you can see that what the olive tree initiative is, it's just a pipeline of savings, of cost cutting. And so they adopt this beautiful sounding phrase, Project Olive Tree, and it's all about cutting costs. That's what private equity gets in there to do, because cutting costs leads to, in the short term, an expanded showing of profits, which makes the overall enterprise attractive when they go to sell in 5 to 7 years. We call this misappropriation, desecration, really disturbing some of the things that they would do here. For example, here we can see that on the right, it talks about blood panel actuals. So they're referring to blood panel, but what they're talking about is, even though they use the word blood panel, they're talking about controlling costs. How much is the nursing cost per patient day, non-nursing, etc. And they describe this in terms of a blood panel, which is something that goes to the health and well-being of residents, and they co-opt these terms. And we see this, throughout. There's a lot of other examples of this. And you can see that one thing they do here is they will email to all the facilities the metrics of the other facilities to get them to kind of compete with each other, to make it a blood sport. And here's part of this email. It says, "Congratulations to Doug Hawkins, who is running the highest occupancy so far. He might want to sleep with one eye open as he has some competition breathing down his neck." So you always create the culture. The culture you create is by the words you use, by the things that you prioritize. And so you can see here that we've got prioritizing of, maximizing occupancy and cutting costs. And of course, the results are predictable. When you incentivize people to do things like that way, they will do things that way. Another thing that we saw that was really disturbing was this installation of Ahi Yafi, who was an individual shown here on the right in this beautiful graphic where he's lording over the CFO of Plum. And he's an individual who works for GI Partners. Now, mind you, I've already told you about the profits that GI Partners, even just the enterprise, had to gain from this. But in addition to this, they put this individual, Ahi Yafi, their own employee, inside the operation of Plum Healthcare, where he actually goes and has an office there, and he becomes an initiative co-owner of Project Olive Tree. So he's there. They're being paid, and you can see that the fee to Plum is $40,000 per month for Yafi to go in there 5 hours per week and just emphasize cost cutting. So they basically get the money coming and going and in every other direction. Just another example of the types of things that are going on behind the scenes if you've got private equity involved. This is sort of a look behind the scenes of the things that we found after many years of developing and securing information through discovery. Scorecards for profits. One of the things that private equity is very famous for doing is creating these scorecards and sort of creating this objective reality that pushes metrics out there that are all focused on money. One particularly interesting thing, these are examples of the scorecard, is number 2, clinical. So what it says at the beginning is maintain best-in-class clinical results, right? And so you're thinking, okay, well, this is good. That's not the deliverable, though. The deliverable is in italics, and you can see that the deliverable is maintain high skilled mix at or above X percentage, steady occupancy rates at percentage, and growth in the existing facility instead of 2 to 3% per year. So these scorecards are how bonuses are delivered, and these scorecards, as you can see, are focused on deliverables that are all about money. You can see that also when we get to labor. It talks about achieve and maintain labor expense margins of a certain percentage. And you can see that in terms of the quote unquote restructuring. It's all about money, And then they create deliverables, which then incentivize individuals who are overseeing and operating these nursing homes to meet these deliverables for their own personal financial gain. Corporate cuts and staffing. Here's sort of an astounding thing we saw in the board of director meeting minutes. They're looking at every nursing hour per patient day. 0.1 equates to $5.8 million. So they're actually monetizing every 0.1 of nursing hours per patient day, and in an attempt to emphasize to all operators of nursing homes to drive down their nursing hours per patient day because of the financial expense of that, and doing it in a pretty crass way here, where they actually put a number to it so that everyone is thinking about things in the same way. Bonuses for profits, period. What we see time and time again when you have a private equity involved or big finance involved is that you see all these bonuses at the facility level that are designed to incentivize conduct by individuals who are maximizing profits. Here we have Ben Tuifua, who is the administrator. He was receiving an astounding 15% of all profits at the facility. Across the Plum chain, all the administrators were receiving 15% of the profits of their facilities. So this led to administrators receiving oftentimes in excess of $500,000, even up to between $500,000 and $1 million a year to run a skilled nursing facility. My wife, who's a doctor, when she heard about that, was astounded by that. You would never see that in hospitals, that you would have line administrators receiving those types of financial incentives. Now, of course, when you create that incentive, that 15% of the profits are going to go to the administrator, you can predict what the focus of the administrator was, which was exactly what we saw in the emails. And you notice that marketing, admissions, business offices, all of these personnel had bonuses. But what about the nurses? Certified nurse assistants, licensed vocational nurses, none of them had any ability to secure bonuses. And so you speak loudly when you talk about how you are going to allocate your bonuses. And if you tell everyone that the bonuses are going to go to all the money people, then you get that result, which is that everyone is focused on money. And again, this is the way private equity can become it's insidious in the way that it inserts itself into the operations of long-term care. This is referred to as the Nancy problem. Kind of a fascinating aspect of this case was that at one point, Mark Balloff, who was the CEO, and he was one of the individuals who was previously a nursing home administrator. He teamed up with his partner, Paul Hubbard, and they started to grow their nursing home chain, and eventually they sold out to private equity. They were talking about wanting to get a person by the name of Nancy Wilson in place as a chief clinical officer, and they're telling the Howard Park, Dennis Sweeney, and Dave Crater, who are the GI Partners private equity individuals. They're telling them that they want this because this is a big enterprise, and they should have a chief clinical officer. Now, mind you, Nancy Wilson has a physical therapy background. She's not even a licensed nurse, and basically, one of the things that Balloff was thinking was that if we get her in as chief clinical officer, we can, for example, maximize our recoveries under the MDSs. But even with that, there was all this pushback, and Dave Crater thought it was a good idea to talk about the fact that, can we really afford that? Now, we're talking about pennies here. The proposed raise was minuscule, and Dave Crater felt that he could step in as a person who's not trained in healthcare whatsoever and ask whether they really should be, increasing her salary by $20,000. It just shows you the level of involvement and the insidiousness of the private equity in terms of its involvement. And here we have Mark Balloff responding by talking about the fact that we don't want to have to spend an additional dollar given the current state of affairs. And in May of 2017, the current state of affairs was excellent for Plum. They were a very profitable facility. The problem is that there were even bigger benchmarks that the private equity had set because they were trying to maximize profits. And it just shows you, though, the level of dialogue here. This is not something where private equity gets involved and says, "Hey, look, we're the Ivy League MBAs who are just getting in this to just at a high level make sure that we're protecting our investment." They are getting into the micro details and doing things that are contrary to patient care. And then there's what we refer to as the Nick problem. So pictured up at the top here is the Nick Anderson, who was the chief operating officer at the time of Plum, and you can see his scope of responsibility, right? So he's basically the main person overseeing all the operations of 63 facilities. And what happened in his deposition was really remarkable. He gave a first session where he kind of towed the party line, but I think he was fed up with it. And by the time we had the second session of his deposition, he made some remarkable concessions where he basically admitted what we all suspected to be true, where he talks about GI, keeping in mind that GI Partners is the private equity company. GI, and these are basically direct quotes, GI was pushing for things that weren't in the patient's best interest. In 2016, they didn't meet the financial expectations. So in 2017, they were doing everything they could. They were putting that kind of pressure. He was concerned himself about what GI was doing to Plum, and he was being pressured to do things for savings. So that's the chief operating officer under oath admitting that everything that we would all suspect, which is that this is what GI was doing on a real-time basis, not just general observations, but getting involved, installing people, and putting pressure on the operators, not for patient care, but to maximize results. Bottom line take home, private equity ownership of long-term care facilities is dangerous. It needs to be regulated. We can't regulate things if we don't know who the owners are. So that's the first step. But after that, there needs to be a lot more regulation and inquiry into the impacts that private equity ownership is having on long-term care. So let's talk about REITs for the next 10 minutes or so. And what we see in REITs is largely the same picture, but let me just kind of discuss what we see from a little bit more nuts and bolts standpoint. There's sort of a fork in the road between the RIDEA TRS structure and triple net leases. And these are two different types of REIT structures. So just to give a little primer on the RIDEA and TRSs, RIDEA refers to the REIT Investment Diversification and Empowerment Act, which was passed in 2006. And taxable REIT subsidiaries are what came out of that. And what the RIDEA structure basically allows for is for REITs to take control of the operations of facilities. And so what we talked about before was, REIT ownership is you think of REIT ownership as being passive landlord ownership. So, okay, yeah, we own the buildings of, for example, an assisted living facility, but we don't have anything to do with the operations. Well, that's not true under these taxable REIT subsidiaries. So basically what ends up happening is that REITs will come in and they will have what are called QRSs, which is qualified REIT subsidiaries, which they get the tax benefits of being merely landlords, but then they will set up separate entities, which are TRSs, taxable REIT subsidiaries. And within those separate entities, they get all the spin-off income from the operations of these long-term care facilities. So you could imagine what happens if a TRS is in play. When you have a RIDEA or a TRS type REIT, the REIT owner has complete control over all profits generated by the facility. They can and do extract that money. So in other words, the money from the operations, not just from the rents, but from the operations, goes into separate accounts that are completely controlled by these REIT owners, and they can siphon that money as they deem appropriate. They do not have to make any kind of allocations for future operations. They can do what they want with that money. Also, they have complete control over the budget. That's always going to be in the operating agreements of these REIT-owned RIDEA structures, where it'll say that if there's the budget is first of all something that they create and initiate in the first place for the operations. We're not just talking about the landlord here, but for the operations of the facility, and then they can require that if there's any deviation that's going on. And this is what they do. If there's any deviation from the budget, it has to be approved by the owner. So they have complete control in that way. And they have control over the management company that runs the day-to-day operations. So under a REIT structure, you have to have a separate management company that is down there on the ground. But of course, they have control over who that management company is. They have the ability to hire. They have the ability to fire. They incentivize the management company to maximize profits. And they have the management company reports to them. And so in this way, it is a lot like, just any kind of direct owner. And a lot of people aren't aware that REITs are using this TRS structure to become basically the operational owner of these long-term care facilities. Now, the RIDEA structure is available for reasons that are sort of arcane tax reasons. It's available in the private pay long-term space, which is assisted living facilities. However, and these are just some further discussions about how that changes, how it's changed the profitability when you have this TRS, how it's changed the profitability from the normal 2 to 3% to 6.6%. This is Ventas, which is one of the largest operators, REITs that is involved in long-term care. But basically, the bottom line is there's a fundamental misalignment. It's not the same as private equity in the sense that they don't have members on the board, but it is the same in that ultimately they have complete control. They have control over the budget, they have control over the money, and they have control over the management company. Now, you might, as I mentioned before, that when you have there are two types of REIT structures. The other one is what we call the triple net leases, where they're literally just the landlords. And in skilled nursing facilities, because of the tax rules and the statutory rules relating to REITs, the RIDEA structure is not available. So you have just triple net leases. And so you might ask yourself, well, I guess we shouldn't be worried about it in the skilled nursing facility context because they're just the landlords in that case. But that is definitely not true. Basically, here's the sort of an overview of what needs to happen in order for them to get exemption from federal income tax. And it basically says that their income has to come from real estate activities as opposed to operational activities. And this is a case example that comes from one of my colleagues, Leslie Clement and Lara Clay Parker. This is a case that they resolved, but it's just an example. It gives you an example of the fact that just because they are a landlord in the skilled nursing facility context does not mean that they are not exerting pressure and control and affecting patient care in the same way. So here you see the entities involved here were CareTrust REIT, and then Calesta was basically the operator. And you can see that essentially there's a joint venture. And the way that CareTrust exerts its control in those situations is that it has an outsized. So the first thing it does is it has the way it is attempting the long-term financial play for CareTrust is to hold for a limited period of time and then to sell the REIT to someone else. Selling the REIT in terms of the attractiveness of the REIT is the same sort of beauty pageant that happens starting in year one and goes from beyond. And it has to do with what kind of spin-off income can the REIT secure by way of rents. And so what they invariably do is they take an artificially high rent, and that is the way that they secure the extra outsized profits. They don't get the profits from the spin-off operations directly, like we talked about in the TRS context, but still they can do it via an artificially high rent. How do they justify an artificially high rent? They have pro formas that show profitability that would support that rent. And how do they get that profitability? Well, the way they get that profitability is two ways. First of all, they shop for the best and most compliant company who is willing to be the operational company, who will understand that the requirement to maximize profits is necessary in order for the profit taking of the REIT. And then second of all, they have careful monitoring. And so, here you see an email where we've got Mark Lamb from the REIT having a conversation with Scott Clausen, who is from the operational arm. And you can see that Mark Lamb is talking about, the fact that, they're talking about Plum, which was actually in the last case, the fact that they want Scott Clausen, the operational company, wants to get more. He wants to get more facilities so they can generate more profits. And Mark Lamb is referring back saying, once you get your arms around these three, once you can maximize profits here and show us you can do it, then we can get in there and get Plum. And so you can see that there is this, like if you were talking about a normal at-length relationship between a landlord and a tenant, like you would see, perhaps in the building that you're working in and things like that, you would never have this kind of micromanaging of the operations of the facility, where they're talking about, for example, here, where there's conversations about, okay, we're going to have our call with CareTrust, the landlord, and we need to get information regarding census, labor, operational expenses, and ancillary. We need to get that information. And why do they need to get that information? Because they are a whole lot more than landlords. They are still generating outsized profits beyond the simple landlord relationship, and they're doing it by way of outsized rental charges that are all driven by pro formas and budgets that purport to show a very profitable underlying facility. If the underlying facility is not profitable, and if the operations company cannot deliver that, then you have a situation where that they are always being at risk for being replaced. So they have their motivation to maximize profits, and the reward, it's a carrot and a stick. The stick is that they will get replaced and they won't get more REIT money. And the carrot is that if they do play ball and they do maximize profits and they do maximize the amount of rent they pay, then they will get more properties. And in that way, the REIT exerts incredible control, even if they are just a triple net lease as opposed to the TRS structure. So that is my overview of big finance ownership of long-term facilities, care facilities, the growth of private equity and REIT involvement, and the dangers it presents to appropriate resident care in long-term care facilities. I'll turn it back to you, Richard.
Thanks, Ed. Thanks so much. There was so much information in a very concise program, so thank you very much. I'm just going to share let me please share. There we go. Um, okay, so I'm gonna have to share my screen. There we go. Back to our PowerPoint. So please join us. I'm sorry. I'm going to provide some time for Q&A in just a moment. A few housekeeping at the end. Few housekeeping items at the end of our program. Please join us in January. We're going to have investigators from the HHA's Office of Inspector General. We're going to talk about two of their recent reports. One of them is on the widespread underreporting of serious nursing home falls, and the second one is on longstanding weaknesses in the Special Focus Facility program and its ability to address persistently poor performing nursing homes. And you could sign up for that here. For materials from today's webinar, I know a number of you asked. As always, they will be available. They are available on our website right now. The program itself, the recording, will be available on that page by the end of the week and on our YouTube page as well. Please follow us on social media for updates, upcoming webinars, and more. Visit Nursing Home 411 for our new Nursing Home Staffing Resource Center. I'm very excited about that and the resources it has to connect people with information and tools to look at, assess, and use that information to improve nursing home staffing and therefore nursing home care. Of course, data and other information on U.S. nursing homes, our fact sheets for our nursing home standards, our assisted living guides, etc. If you can, we would appreciate if you could support the coalition's year-end fundraising drive. All donations are tax deductible and used in support of our mission, and of course, very much appreciated. That is the top QR code, or you can go to nursinghome411.org/donate. And then for updates and invites to future programs, please use the purple QR code at the bottom or go to nursinghome411.org/join. And with that, I'm going to stop sharing and open it up for Q&A. And we have about 9 minutes for Q&A. So we'll try to get through these fairly quickly. Holly Eaton asked, you said the purpose of private equity investment is to purchase an enterprise, improve it, and sell it at a profit. If the care has been shown to decline after acquisition, why are they still investing in them? How are they able to sell them at a profit?
Yeah, so one of the things that's really unfortunate in the long-term care space is that there is a lack of transparency and reliable data regarding care. Obviously there have been many efforts, five-star, system and so forth, but this is a very imperfect marketplace, and typically residents end up in facilities at recommendations of, for example, discharge planners and other dynamics that are going on. And so the problem right now is there is the bad operators are not punished very much for being a suboptimal operator, and therefore, you can be profitable, you can have suboptimal results, and that process can continue and has continued year after year, and that's the way this process continues to happen, where you get suboptimal patient outcome results, you get higher and more optimal financial results, and around and around it goes.
Thanks. Yeah, I think one issue that has always been in the back, if I may just add, Ed, of a lot of the work we do is the lack of choice that people have in terms of going to a nursing home. So, and so in a situation like this, to add to what Ed was saying about the question, is that most people really don't have a lot of choice. They're sent to facilities that their insurance covers, that the hospital sends them to, et cetera. So in that setting, as Ed was saying towards the end of his program, there is it's not a healthy marketplace for good competition and for these things to kind of wash out. Unfortunately, it's a marketplace in which there can be bad products that still make a profit over and over again. Richard Moore asked, hi, Richard. Massachusetts is considering legislation to prohibit investment by the public pension funds in private equity and REITs that own or invest in long-term care, nursing homes, and assisted living. Is this a good policy to pursue?
I would say yes. One thing I can say about private equity, because I'm asked about this a lot, is there may well be a place for private equity in certain as it relates to other types of products where focusing on short-term outcomes does not, it does not cause death and injury. So for example, as I always say, like if private equity, one of the things that GI Partners was involved in was a revamp of Duckhorn wine. Okay, if GI Partners comes in there and says this is the way that we have revamped other companies operationally, and if it doesn't work, maybe the wine doesn't taste good, or maybe they lose a percentage of their sales. That's a whole different thing than if it doesn't work, people are going to die. And so I don't think private equity, the way it's currently configured, unless there were a lot more restrictions on its ability to be involved in the operations, I don't think the way it's currently configured, with the lack of regulation, it should be involved in long-term care whatsoever.
Thank you. And I apologize to those. We have 16 questions. I'm going to skip ahead to some that I think are particularly that Ed's expertise and knowledge would be particularly valuable on. Eileen Henshaw, hi Eileen, asked, what states have promising approaches to combat private equity investment abuses?
I do not know. I mean, I think that there's been lots of discussion at the federal level, at doing things at the federal level, because I do not believe any states have any kind of model that is that we're looking at. I know that I work a lot with Charlene Harrington, and California, of course, tends to be at the front end of some of these things. We have nothing. And so I'm assuming that there's very little out there as of now. Richard probably could post something after. I'll volunteer Richard to post something afterwards. But I'm guessing it'd probably be an easy research project, because I don't think there's a lot of it.
No, I mean, I think there were some efforts post-COVID. I know here in our home state of New York, there is a prohibition against publicly traded corporations owning facilities, but we actually see a lot of the same players. They're just operating in a different structure. But we even have operators that own REITs out in California, at least one that I've seen. But a lot of the same things going on, even if there's not specifically a REIT or a private equity presence. I thought this was an interesting question. Oh, someone noted, Alexis Showman noted, Texas passed a bill that would increase ownership reporting last session. Thank you. Anonymous attendee asked, how can we tell if a facility is owned and controlled by a REIT or private equity firm?
Yeah, and that's the problem. We can't. I mean, you go You start by going, you're trying to understand about a facility, right? Where's the first place everyone goes? They go to the website of the facility. I've always been an advocate, and I don't understand why this can't pass when we talk about transparency of just requiring them to put their ownership right there on their website. By far, that's the number one place that people are going to go to try to understand. But I guarantee you can go look at any facility right now that's owned by private equity or REITs. You can go on their website. You will have no understanding of who owns them. Now, even if you could get a little further down the line, for example, there are cost reports that purport to require, disclosures, and so in California and federal cost reports, and I know in other states. The problem with those is that there is no enforcement of violations of those disclosures. So in the trial I was referring to, we showed their cost reports. It was very beneficial to us in the trial, but we showed their cost reports over the 5 years, over like a 5-year period. There was no disclosure of anything close to private equity in any of those years. And a lot of times it would have, you're required to disclose anyone who has a 5% or more direct or indirect ownership interest. And they would disclose things like OpCo holdings, like just something that you could never possibly divine. And so the simple answer is, how are you as a consumer or as a consumer advocacy group supposed to alert people to the dangers that I've talked about in those studies where you're not going to have the opportunity to go get all those emails, but you can look at those emails and say, well, wow, private equity does get really involved in a micro way that is scary, right? But how can you even have that conversation if there is no way for you to figure out whether facilities are owned by private equity? It's absolutely wrong. And it's why I think that consumer advocacy groups such as this one focus on issues of transparency, because it's just ground zero. You can't do anything without knowing basic facts about ownership.
All right. Thank you. Thank you. So 2 questions that were at 1:59. I'll try to go quickly. But Thomas Daniels, I thought this was really interesting. He said, nasty, but did GI break any laws?
I mean, no. I mean, there's not something that would be illegal. I mean, we talked about the 5% ownership disclosure. I would say that GI broke that law to the extent that it's a law. But the part of what we're dealing with is the fact that and this is where all of the lobbying and everything that is the question of what role should be played. Right now, it's the Wild West, and it's the Wild West in the sense that there's no regulation of private equity. It's the Wild West in the fact that assisted living facilities are very lightly regulated overall, let alone when it comes to ownership. And so breaking laws, no. And that's why the only accountability that we're seeing right now is through civil litigation, where we have to go and that's obviously a very inefficient process for effectuating change. The more effective is legislation. We're not in a good environment for that right now, but the hope is that great organizations like this continue to keep pressing on that, because we can't make long-term care better at the bedside without knowing who's in the boardroom.
Wow, that's a great quote. I'm tempted to end there, but I actually have another. If we can go on for another 5 minutes. Excuse me. Carl Varner asked a long question, but it's some interesting points, I thought. This relates to the email clip you shared in an early slide, specifically, and maybe this does not apply to the case of Plum, but when you see an email in which a board member or senior management is praising the facility manager for their high occupancy rate, is it possible that this facility manager just did a good job of marketing the facility to potential residents or patients? And this is what explains the high occupancy rate. Or is it assumed that there must be some kind of Medicare or Medicaid or other third-party fraud involved, whereby the facility manager, for example, could only obtain high occupancy by illegally gaming the system, e.g. approving longer facility stays or healthcare procedures, even when there is no medical need?
Yeah, so my answer to that would be that I'm not saying that per se having high occupancy rates is indicative of gaming the system. What I am saying is that culture, it's all about priorities. It's all about culture. It's all about what's being talked about by the administrator day by day with the corporate overseers. What is the emphasis? What is the point of emphasis? When you create an environment where you incentivize these administrators to get 15% of the profits, where the conversation coming from corporate is the focus is on maximizing occupancy, minimizing costs, as opposed to beating the drum every day about the importance of resident care, then that's the outcome you're going to get. And when you have private equity, they're not thinking about, and they don't care about resident or patient outcomes. They're focused on, on occupants, the things that drive revenues and, reduce expenses. They push that down to the management company, who pushes it down to the operators, and that's why you get dynamics like the ones that we see, which is adverse to patient outcomes. So it's not so much that having high occupancy means per se that there's anything, untoward about that occupancy. And in fact, high occupancy sometimes is connected to, an indication of good care. It's just that when you focus everything in one direction, you're predictably going to get people who are, are focused on that. You meet them, as they always say, meet a guy in a bar, you get a guy who goes to a bar. You focus on that, you're going to get that outcome. And that's really what the point of the email was.
Yeah. Thanks so much, Ed. Thank you very much for a really thoughtful and thought-provoking program. We really appreciate it. Again, I welcome people to visit our website, nursinghome411.org. We actually do. Eileen Henshaw reminded me that she did for us a report on some promising practices that states were doing towards the end of the COVID pandemic to improve accountability. Not exactly on target here, but somewhat. And that includes New York, New Jersey, Connecticut, Massachusetts, if I remember correctly. And California has some movement going as well. And also, if you're interested in finding out more information about who owns your nursing home, you can visit the provider data on our website or on CMS's website. And it's not great, as you can tell from Ed's presentation, but they do have to report, at least if they're part of a chain, what that chain is. And that could be both for-profit and not-for-profit. But Ed, again, thank you so much. We appreciate all of you joining us today, and have a happy and healthy holiday season.
Thank you, Richard.
Thanks,
Bye,
Ed.
everyone.
Bye-bye.